Hello, good morning, and welcome to Unacademy IAS, a one stop destination for all the English medium civil services aspirants. Welcome to one session of Indian economy where we are going to discuss the first chapter in the 12th class Maharashtra board 12th class standard, that is the national income. Now, before I start the session, those present in the session, can you please confirm that I'm audible and visible for all of you? Those present in the session, can you please give the confirmation? Am I audible and visible for all of you? Give the confirmation. Am I audible and visible? Okay, great. Let's start. So, welcome to this particular session where I'm going to discuss one of the very important chapters for UPSC Prelims as well as the mains examination, which has been discussed in the 12th class Maharashtra board. The chapter name is National Income. But before I start, the UPSC Civil Services Exams 2025 results have been announced, and we are happy to say that in the final list, more than 100 learners of Unacademy IAS are present. In this particular list, more than 100 students were part of the online learning batch, and basically, as a part of celebrations, we have cut down the prices of our courses to 16,999. I've been told that the offer has been extended for a couple of more days. Those interested in enrolling, do check out the details by clicking on the link provided in the description. Now, in addition to this, if you're somebody who is preparing for the civil services, I know there are certain important advanced concepts in the economy that you feel are very difficult. Now, in order to discuss this, I've scheduled a special class on 14th March 2026, that is today at 8 p.m. This will be conducted on the platform. This is the QR code. You can scan and join the session. And tomorrow again, 15th March 2026, one more session at 8 p.m. on the Unacademy IAS platform. Please join, and we shall discuss the important economic concepts which are advanced in nature, and we will basically understand how these are relevant for the civil services examination. Do not miss out these particular sessions. Now, let me start the discussion. The chapter on national income. What are the important points? What are the important concepts? Point number one, whenever you talk about countries across the world, across the globe, there is this concept of gross domestic product. GDP, gross domestic product. Gross domestic product simply refers to the market prices, I repeat, the market prices of all the final goods and services. All the final goods and services which are produced in the territory of or in a particular territory for a certain time period. For example, when I say territory, you basically take, let's say, territory of India, and in the territory of India, right? Let's assume within the territory of India, what is the market price of all the goods and services? Of course, final goods and services which are produced for, let's say, a quarter or a financial year will be calculated. Is this for 2026 prelims? Yes, my dear. Relevant for 2026 prelims, and for that matter, any competitive exam that you appear for. Okay. So within the territory of India, the market price of all the final goods and services that are produced are counted, are calculated, and this is essentially called as gross domestic product. Now, why do we need to measure gross domestic product? Is there any logic behind it? Why should we calculate gross domestic product? Reason behind this is very, very simple. You see, there is a need to compare one country with another country. For example, I want to compare how is India performing against, let's say, USA. How is India performing against China? In addition to this, we also want to compare how is India performing today compared to, let's say, 2 years ago. What has been the impact of the policies of the government of India, etc. So, whenever you want to compare the performance of the economies, one parameter that is used is basically to identify in terms of economic activity measured using an indicator which is called as gross domestic product, GDP or gross domestic product. Is everybody okay? We can make a comparison using number of goods. Understand this. You can compare the performance of these particular countries using the number of goods. But the problem with the number of goods is from one country to another country, it's not a right parameter. You could have produced, let's say, large quantity of small value goods. You could have produced, right, let's say, small quantity of large valued goods. That is in terms of market prices. In addition to this, you're also producing the services. So when you want to compare the performance of an economy, the right way to compare is using the value of the goods and services which are produced in a particular country. That is the reason we measure gross domestic product. Is everybody okay? Please do let me know. Those present in the session. Is everybody okay with why do we need gross domestic product? Why do we measure gross domestic product? Everybody is okay? Now, when you talk about gross domestic product, please understand there are multiple ways to measure the gross domestic product. Multiple ways. I'll discuss all of them one by one. But before I start the discussion associated with measurement of GDP, listen to me carefully. There is a term called as the participants or economic agents. Participants or economic agents in the economy. What do you mean by economic agents? Anyone who will contribute to the economic activity. Anybody who is going to contribute to the economic activity is referred to as an economic agent. For example, we have household. And what is the meaning of economic activity? Anything that is produced and basically supplied in the market. That is called as economic activity. Right? So household. Households are part and parcel of economic activities. We have companies, or else these are also referred to as firms. These are also part and parcel of economic activity. We also have the government. We also have the government, which is also part and parcel of economic activity. Now, what is the use of understanding the economic agents? Now, you want to, let's say, measure the market price of all the final goods and services which are produced within the territory. How can I do that? I'll basically measure this using a concept called as circular flow, right? Or circular flow model or circular flow methodology. And what do I mean by circular flow? Listen to me carefully now. In economics, there is basically understanding that the expenditure of one person is equal to income of another person. I'll repeat the statement. Expenditure of one person is equal to income of another person. That is, let's say today if I go to a restaurant and I'll pay 10 rupees to purchase, right, a cup of tea, then essentially that 10 rupees is an expenditure for me, but income of another person, that is the restaurant owner. So in the same way, the circular flow will help us in determining the total amount of transactions, the total sale of goods and services, etc., that have taken place in the economy. Right? Let's understand this. The two-sector model. Initially, there is a model called as a two-sector model. What is a two-sector model? Simple. It is between a company, that is the firm, as well as, right, let's say an individual, that is a household. This is the connection that can be established between both of them in two sector. Here is a household. The household, step number one, will supply labor. It will supply labor to the company. And the company in return will pay wages which will go to the household. Is everybody okay with this equation here? Please do let me know. Is everyone okay with this equation? The house will provide, right, let's say labor to the firm, and the firm in return will pay wages to the house. Right? Now, the house will use the wages, that is basically the money, to purchase goods and services. To purchase goods and services which will be supplied by the firm in the market. Right? That is, the house will pay money to the company and the company will supply the goods or services which have been produced by this particular company. Is everybody okay? This is basically the representation of a two-sector model. Representation of a two-sector model, right? Where only two participants, the household, right? That is one of the stakeholder in the economy, and the second one is the firm or the company, right? So this is two-sector model. Then in addition to this two-sector model, you can have three-sector model. In three-sector model, we have the companies, we have the households, along with that we have government. So within these particular, right, three-sector model, transactions will keep on happening between all the three stakeholders. Then we can have a four-sector model as well. Four-sector essentially refers to, right, the external market. Four-sector will include external market. We have, right, the private sector, that is the companies or the firms. In addition to firms, we have households. We have households. In addition to households, we have the government. These are present anyways in the three-sector model. Now, in addition to all the three, we also have the fourth, that is basically, right, the external market. How is the external market connected to all of this? You will be exporting, you will be importing. You will be exporting as well as you will be importing. All the four put together, right, essentially is called as a four-sector model. Now, having looked at two-sector, three-sector and four-sector model, let me make you understand how GDP calculation is done. How the GDP calculation is done in the economy. Listen to me carefully. I told you what is GDP? The market price of all the final goods and services which are produced within the territory of a country, which is calculated for a specific time period. Now, in the context of India, who calculates and publishes GDP? It is done by Central Statistics Office, CSO, Central Statistics Office, which functions under Ministry of Statistics and Program Implementation, Ministry of Statistics and Program Implementation, that is MOSPI. Now, what does this authority do? How is the GDP calculated? Right? What are the important points to remember in the context of the GDP calculation, etc.? Let's understand them one by one. Now, you need to calculate the market price of all the final goods and services. How do I calculate it? There are essentially three methods. Let me explain to you all the three methods one by one. First method. The first method is referred to as, the first method which will be used to calculate GDP is the production method. It is the production method. Production method, it is also known as value addition method. Second method is the expenditure method. Second one is the expenditure method. And the third one is the income method. Production, expenditure, and the third one is the income method. What is the meaning of each one of them? How do we calculate GDP using each one of them? Let's start now. First one, production method. What is done in the production method? Under the production method, we need to simply calculate GDP by considering all the goods and services which are produced within the territory of a country. And from this particular market price of all the goods and services which are produced, we subtract intermediary goods. We basically subtract intermediary goods. And once you subtract the value of intermediary goods, you are essentially left out with the market price of final goods and services produced. Is it okay? I'll repeat it again. You take into consideration all the goods and services produced, and from that you subtract the value of intermediary goods and services. Now, what is the meaning of the intermediary goods and services and the final goods here? Let me explain that with a simple example. You want to produce, let's say, a packet of biscuit. You want to produce a pound of bread. You want to produce a particular good. Now, in order to produce this, you will consume certain intermediary goods, that is inputs. In simple terms, inputs. For example, in order to produce a packet of biscuit, I will consume wheat. In order to produce a pound of bread, I will be consuming wheat. In order to produce a machine, I'll be consuming lot of inputs, that is components. So whenever you purchase something that you will use to produce another good which will sell in the market, it is important. I'll repeat it again. You purchase something or you produce something which you will use it to produce another product, and then you sell the product in the market. This particular good that you are using to produce is called as an intermediary good. For example, if I purchase wheat, either I purchase or produce wheat, and I use the wheat to produce, let's say, a biscuit. In this case, the wheat will be considered as an intermediary good. And the biscuit that I sold in the market, which will be purchased by the buyers, which will be consumed by the buyers, this biscuit will be called as a final good. Is everybody okay? Right, the wheat will be considered as an intermediary good and the biscuit will be considered as a final good. The basic way to understand this, or better way to understand this, is anything that is procured for purposes of consumption, not for value addition, not for the purposes of the sales in the market, that particular product is called as a final good. But whenever you purchase something which will be used as an input for something else, which will be used for producing something else, value addition happens and you sell that in the market, that is called as an intermediary good. Is everybody okay with the idea or the distinction between an intermediary good and a final good? So in the calculation of GDP, please remember this, you consider the prices of final goods. I've told you the definition multiple times by now. We consider the prices of the final goods, not the prices of intermediary goods. The reason behind this is, if you count the value of intermediary goods along with the final goods, you are essentially double counting. You are double counting. The GDP number will be greater, but you will be counting the intermediary goods value multiple times. For example, I'll purchase wheat, I'll pay 2 rupees. And I'll produce a biscuit packet, sell it in the market at 5 rupees. So in the calculation of GDP, if I take wheat value as well as the value of the biscuit packet, 2 plus 5, that will give me 7 rupees. It will give me a GDP of 7 rupees. But the problem is, in the 7 rupees, right, we have 2 rupees of wheat, 5 rupees of biscuit packet. In order to determine the 5 rupee value of a biscuit packet, I've already counted the price of 2 rupee. I've already counted the price of 2 rupee. So that will lead to double counting. That is the reason we do not consider the value of intermediary goods plus value of final goods. That will lead to let's say a higher number of GDP. We remove value of intermediary goods. Everybody is okay? This is how we calculate GDP using the production method. Then there is a expenditure method, and this is where all the, right, let's say participants, the four, right, let's say four participants, or let's say the circular flow, the four participants in the circular flow, that is firms, households, government, as well as external market. All the four components can be used to calculate GDP here. Now, what is the calculation under the expenditure method? Simple. Let's start now. Under the expenditure method, what we generally do is, we take the overall expenditure done by the household, the company, as well as the government. The household, the companies, as well as the government. These are the three economic agents within India: household, companies, and the government. And what we do is, the overall expenditure on final goods and services, overall expenditure on final goods and services is calculated. Let me show you a calculation. Let's assume here is a household. The household, let's say, has spent 100 rupees to purchase final goods and services in the market. In addition to household, we have companies or firms. They have spent, let's say, 200 rupees to purchase final goods and services. In addition to this, we have the government, which has spent, let's say, 300 rupees to purchase final goods and services. Now you will get the number 600 rupees. You will get the number 600. You can simply say 600 represents the market price of all the final goods and services which are consumed, I repeat, which are consumed by household, companies, as well as the government. But it is not equal to GDP. I hope you understand this. I'll repeat this. It is not equal to GDP. The reason behind this is it is representing the market price of the goods and services, final goods and services, which are consumed. But what is GDP? When it is produced in India, the final goods and services, when it is produced in India, you calculate by taking the market prices of all these final goods and services. So what is the problem here? The problem is when you calculate the total expenditure done by the government, household, as well as the firm, it will give you market prices of all the goods and services consumed in India, but not all the goods and services produced in India. Some of the final goods and services which are consumed here could have been imported into India. Could have been imported into India. And some of the goods and services which are produced in India could have been exported and consumed, let's say, in the USA market. So there is a problem with this kind of a calculation. We need to address, we need to adjust those particular numbers. So what do we do now? We will basically make an adjustment. That is the total expenditure done by all the three. From this, I will basically subtract the value of goods and services which have been imported into India. And this will give me, right, 600 minus the imported value will give me all the final goods and services which were produced in India and consumed in India. Is my statement clear? Which were produced in India and consumed in India. But in order to calculate GDP, I will also have to add the value of the goods and services which were produced in India and exported from India. This particular number, that is 600 minus import plus export, essentially will give me the market prices of all the final goods and services. I repeat, the market prices of all the final goods and services which were produced in India, irrespective of whether these were consumed in India or outside India. This will give me the market prices of final goods and services which were produced in India. This is essentially how the GDP is calculated using expenditure method. Is everybody okay with the discussion? First one is the production method or the value addition method, and the second one is the expenditure method. Now there is a third method, income method. Right? The third method to calculate GDP is the income method. How do I calculate GDP in the income method? Simple. You take the sum total of all the incomes which are generated within India. I repeat, you take the sum total of all the incomes which are generated in India. And what do I mean by income here? Essentially, somebody has provided a factor input. Factor input in simple terms means anything that is consumed for production of good or a service. Anything that is an input for production of good or a service. For example, a company will hire a labor. The company wants to manufacture a good. The company will hire a labor. Now, when they have hired a labor, right, they will have to pay wages. They will have to pay salaries. So this is basically part of the income. The company will purchase raw materials. They will have to pay money for it. The company will take a loan to produce a good. They will have to pay interest on it. Right? So there are multiple ways through which incomes are generated, and these are technically referred to as factor incomes. Factor incomes. And what is the basic idea of a factor income? It represents, right, the incomes generated. It represents the incomes generated whenever there is a need for production of goods and services and something as an input, something has been consumed by the company. It could be labor services, it could be, right, the capital, it could be the raw material, etc. So you take the sum total of all the incomes generated in a particular country. And again, I'm emphasizing on this particular fact that we need to focus on a particular country for a simple reason. Remember, GDP is a geographic concept. GDP is a geographic concept. That is, we need to focus on the territory. Within the territory, how much is the production done? Right? So that is the reason GDP is a geographic concept. Please remember that. So first one is the production method. Second one is the expenditure method. And the third one is the income method. Is everybody okay with the three methods now? Is everybody okay with the three methods? Right, so these are the three methods which are used in order to collect the data and calculate gross domestic product. Now, next important point, whenever you are calculating GDP, you need to be aware of certain important points. You need to include something, you need to exclude something. There are certain important points that you are supposed to be aware. Let's understand them one by one. First, and the most important one, whenever you are calculating GDP, whenever you calculate GDP, that is a gross domestic product. I've already told you this, you do not count intermediary goods. You do not count intermediary goods. You only count the final goods and services. Intermediary goods and services are not counted. Reason behind this is, if you count intermediary goods and services, it will lead to double counting. I already explained, just one important point. Second important point, there are certain payments in the market which are called as transfer payments. Transfer payments. And what do you mean by a transfer payment? Transfer payment essentially refers to those monies which are transferred, but in return, no good or a service is taken. You're simply transferring money, but in return, you're not collecting anything. This is called as a transfer payment. For example, Government of India will provide lot of subsidies. The Government of India will provide lot of subsidies. And when the government will provide these particular subsidies, let's say to the farmers, let's say to the elderly people, let's say to the students, etc. That is scholarships, by the way. So in lot of these particular instances, the government simply transfers money. In return, the government is not collecting any good or a service from the people. So these essentially are referred to as a transfer payment. But again, please understand, does it mean transfer payment is always done by the government? Are there any other types of transfer payments? Remittances. Let's say you settle down in America, and after settling down in America, you are earning certain amount of salary. Part of the salary you will send it to, let's say, your parents, your siblings, etc. That is also, right, basically a type of a transfer payment. But please understand, in the context of the GDP calculation, the transfer payments, because in return, no good or a service is collected, right? This is basically not counted in the calculation of GDP. It is not counted in the calculation of GDP. Everybody is okay? So first one is intermediary goods, not counted, right? Transfer payments, not counted. What about, let's say, the goods which are resold? What about the goods which are resold? What do I mean by that? Let's say I've taken a particular product, a car, back in the year 2025. Okay, last year I took a car. This year I will resell. I will sell the car again in the market. Now, should the price of the car, because it has been resold this year, should the price of the car be counted as a part of GDP this year? Answer is no. The price of the car will not be counted. What is the reason behind it? The reason behind this is, when you purchased the car last year, the production of the car has happened. The market price has been accounted in the calculation of GDP. And because the price has already been accounted, you do not count the market price of the car again in the calculation of GDP when it is resold this year. But one more very important point to note here is the fact that when you resell the car, let's say you are using a particular company service, it could be Maruti, True Value, Car Dekho, Spinny, etc. Now, these particular companies will earn certain commission. These companies, because they are providing the services, they will earn certain commission. And whatever commission has been generated, here, the commission will be counted as a part of gross domestic product. The commission that is generated upon the reselling of the good will be counted as a part of gross domestic product. Is everybody okay with this idea? Right? So these are certain important things that you need to remember. In addition to this, there is also a lot of problem in terms of calculating GDP. Lot of concerns, lot of problems are there when you calculate GDP. What are these concerns or problems? First one, when you are producing goods and services, you will consume lot of resources. You'll be consuming lot of resources. Now, when you talk about GDP, right, this particular GDP number will not tell you the information regarding how many or what is the value of resources that you have consumed. It will not give you information. And for that particular purpose itself, there is one more type of a GDP which has been introduced. There is a term called as a green GDP. Green GDP. Normal GDP, for example, in the newspapers that you read about India, they'll say India's GDP is $4.3 trillion, $4.4 trillion. India has a target of achieving $5 trillion in the coming years, etc., etc. So when you talk about these GDP numbers, this does not provide you the information regarding how much is the consumption of resources. Right? What is the consumption of the resources? That information is not provided. So apart from the GDP number, there is also one more concept called as a green GDP. In the green GDP, it is essentially the accounting mechanism where the resources that you have consumed, the reduction in the resources, the value of that will be used and subtracted from the GDP number to get one more number which is called as a green GDP. So point number one, whenever you're talking about GDP, it doesn't provide you the information regarding the consumption of resources. Second, the GDP number that you calculate and talk about India's GDP, it does not provide you the information regarding the inequality that is present in the system. It doesn't give you information regarding poverty that is prevalent in the system. It doesn't give you information regarding how much money has been earned by how many people. And very often in the context of India's GDP, you will come across a statement saying that there is, right, let's say increasing wealth inequality, there is increasing income inequality, etc. And these are reported by, or these kinds of reports have been published in the past as well and will be published in the coming years. Argument is very simple. GDP represents the total income generated in the whole economy. But how much of the income has gone to richest 1%, richest 10%, lowest 50%, etc., etc., that information will not be provided under the concept of GDP. For that, again, you need to understand, evaluate, conduct studies, etc., which will give you the information how much of this is going to the top 10, how much is going to the bottom 50%. Right? So that kind of information, quality information is not provided. What about, let's say, regional disparities? Regional disparities. There are certain states which are very well developed, and there are certain states which are lagging behind. Will the GDP number provide you the information associated with this? Again, the answer is no. Answer is no. Some of the states will contribute very high. Some states will be lagging behind. That information will not be provided under the GDP calculation. And one more very important problem with the calculation of GDP is there is a presence of huge amount of black money in the system. Black money in the system. And this particular black money, which is present, which is prevalent, which is used for circulation purposes, used for purchasing goods and services, the information associated with that, it is very difficult to get. And that's a reason it is also very difficult to get this number, right, estimated, and basically it is very difficult to account for this in the calculation of GDP. And one more very important problem associated with the GDP calculation is the fact that in India, there's a huge presence of informal economy. There is a presence of huge informal economy. What do you mean by informal? Let's take a company such as, let's say, Reliance or Adani Group of Enterprises. We say these are part of organized economy. These are part of, right, formal economy. Meaning what? They are registered. The numbers associated with them is available to you, etc. All this information is there. But in case of Indian economy, there's a presence of huge informal system where the entities are not registered. The number of employees present are very, very low, right? And this makes it very difficult for us to estimate the GDP number because these are not registered. It makes it very difficult for us to find out what is the production done by these entities, how much is the income generated by these entities, what is the contribution to the GDP. Again, I'm saying we estimate, but is it accurate or inaccurate? There are concerns associated with that. So these are some of the challenges in the context of calculating gross domestic product. Done? Right? So these are certain important points. Now, in addition to this, there is, right, again, the pictures I've given are from basically the textbook of class 12th of Maharashtra board, right? One of the chapters is on national income. I've highlighted the important points. You can use it. Now, in addition to GDP, there are other types of indicators as well. What are the other types of indicators? In addition to GDP, we have GNP. GNP stands for gross national product. We have, right, NDP, net domestic product, and we also have NNP, net national product. I'll repeat it. We have GDP. GDP is the most often used indicator in the global market. Countries around the world, for example, India, USA, China, right, European Union countries, all of these calculate GDP and will keep on fighting with each other, right, in terms of, right, let's say ranking under the GDP. But apart from the GDP, are there any other indicators? Yes, there is GNP, there is NDP, and then there is NNP. What is the meaning of each one of them? Let's discuss that. First is GDP, we have taken care of it. Second one is GNP, gross national product. Gross national product. What is this gross national product? How is it different compared to GDP? GDP, like I said, is the market price of all the final goods and services which are produced within the territory. It is a geographic concept. Now, in addition to this, there is also a nationality concept, that is GNP. In GNP, the focus is on the market price of all the final goods and services which are produced by the residents of India. I repeat, the gross national product focus is on nationality. Production done by whom? GDP, production done in India. GNP, production done by residents of India. That is the market price of all the final goods and services which are produced by the residents of India. Whether they are within India or outside India, doesn't matter. It is basically focused on production done by the residents. What do you mean by this? Let me give you a basic idea here. In GDP calculation, let's imagine there is a, right, let's say certain contribution done by the residents of India, right, as well as the non-residents. That is, in simple terms, there are foreigners. Again, please understand this. The term resident is slightly technical. I'm using foreigner to represent, but it is not completely accurate. Okay, so foreigners who are present in India will contribute to India's GDP. Right, so I'll basically take this as a production done as 100 rupees. And along with this, there are Indians who are present in India. Indians present in India producing and contributing to India's GDP. I'll take it as 200 rupees. So because the production has happened in India, the market price of all of these, put together will give me India's GDP, 300 rupees. So now this is how GDP is calculated. Let's understand how GNP is calculated. In GNP, the focus should be on the residents of India. Whether the production has happened within India or outside India does not matter. Contribution is done by the resident, we will bring that into consideration. We need to account all of this. How do I do that? Basically, from the GDP, again, I'm saying this, although I've used the term foreigners, it is not exactly the term foreigners, it is residents and non residents. Now let's start. Right, the GDP basically will have the contribution, right, in this way. That is, anything that is produced in India, take a sum total, get the GDP. So how do I calculate GNP? The formula is very simple. You take GDP and adjust that with net factor income from abroad. Net factor income from abroad. In simple terms, what is the production done by residents of India but outside India? Is it okay? What is the production done by residents of India but outside India? Now let's take a simple example. Imagine a software engineer. Imagine a software engineer will be sent to USA for a period of 3 months. The software engineer is a resident of India, but because he is working outside India or she is working outside India for a duration of 3 months, essentially here is the production done by resident of India but outside India. When you calculate GDP, I repeat, when you calculate GDP, because the production is happening outside India, you exclude it. But when you calculate GNP, because this has been done by the resident of India, irrespective whether in India or outside India, because the production has been done by the resident of India, you will count it as the part of GNP. Is everybody okay? You will be counting this as part of GNP. So simple formula. In GDP, you have the production which has happened in India, which has been contributed by residents as well as non-residents. From this particular GDP number, I repeat, from this GDP number, you subtract the contribution done by the non-residents of India. For example, a foreign individual or a foreign resident, for example, resident of USA coming to India, working in India for a period of, let's say, 5 months. Working in an Indian company as a consultant, let's say, for 3 months. So the production has happened in India, hence we have counted this as a part of GDP. But when you move from GDP to GNP, you will take out such types of incomes that have been generated by non-residents. So from the GDP, essentially what we need to do is remove the revenue or the factor incomes generated by the non-resident and add the incomes generated by the residents but generated outside India. And by adjusting this, by making this kind of an adjustment, what is left out? Let me give you a simple calculation to make you understand here. Right? So GDP, let's assume resident of India, within India, the income generated is 100 rupees. Resident of India and working in India, right? The income generated is 100 rupees. Now, in addition to this, there is, right, let's say 50 rupee income generated by a non-resident of India, but working in India. So this is, right, basically GDP number, 100 plus 50. Total incomes, that is GDP number. But listen to me now. When I want to calculate GNP, I will have to remove this number. I'll have to subtract this particular number. And let's say there is an individual Indian resident who has worked in USA and generated certain income. So what will I do? Net factor income from abroad, NFIA. Net factor income from abroad. How do I calculate it? Simple. I will basically add the factor income generated by resident of India but abroad, outside India. A means abroad. I will add resident of India, right? This is a resident of India, but the income is generated outside India. I will add that and I will subtract, right? Basically, the non-resident Indian who has worked in India and generated income. Let's assume, right? This is 80 rupees, and this I've already calculated is 50 rupees. So 80 minus 50, right, that will be 30 rupees. So the calculation will be GDP, that is, right, basically 150 rupees plus 30 rupee. So the GNP calculation will be done like this: 150 plus 30, 180 rupees. Done. So GDP is a geographic concept. I'll repeat the statement. GDP is a geographic concept, whereas GNP is a nationality concept. In GDP, we focus on whether it is produced within India or outside India. Only what is produced in India will be counted. Whereas in case of GNP, geography is not a matter. It could be produced in India or outside India, but it should have been produced by residents of India. It should have been produced by residents of India. So that is basically the idea of GDP and GNP. Then there is NDP. NDP. What is this idea of NDP? NDP stands for Net Domestic Product. Net Domestic Product. Now listen to me very carefully. When you calculate GDP, Net Domestic Product, when you calculate GDP, Gross Domestic Product, you will basically consider the market price of all the final goods and services produced. But there is a problem. What is the problem? In order to produce these final goods and services, I'm going to use machinery. Correct? I'm going to use a lot of machineries. Right? And these particular machineries, because I'm using them to produce goods and services, will undergo wear and tear. And basic idea is there is a term called as depreciation. There is something called as depreciation. What is this idea of a depreciation? You purchase a machine today. You will use the machine. The machine will undergo repairs. The machine will undergo wear and tear. And because of all of this, the value of the machine will keep on decreasing. Is my statement clear? Because of all of this, the value of the machine will keep on decreasing. And that reduction in the value of asset is nothing but the machine that you're using, the trucks that you're using, the manufacturing facility, etc. These capital assets, they will keep on losing value. And when they lose value, that is called as depreciation. When they lose value, that is referred to as depreciation. So when you calculated GDP, when you calculated the GDP number, you did not account for depreciation. You did not take into consideration depreciation. So what you do now, in order to calculate net domestic, and please remember, gross means the total. Gross simply means the total. Net means from the gross, you're making certain adjustments to get net. Gross minus adjustments or gross with adjustments is called as net. So how do I calculate net domestic product here? You take GDP number, gross domestic product, and because you're producing these particular goods and services, certain reduction in the value of the assets has taken place. From this, you deduct or subtract depreciation. And what you get after this is basically net domestic product. What you get after this is basically net domestic product. So GDP minus depreciation will give you NDP, net domestic product. This is a much better indicator, qualitatively, a much better indicator compared to the gross domestic product. Right? In fact, the Ministry of Statistics and Program Implementation has already announced that they may consider shifting away from GDP to NDP maybe by the year 2029 and 2030. Let's wait and see whether the government of India will do this or they will continue to focus on GDP as they're doing right now. Right? So one is GDP. We have taken care of that. Second one is the GNP. Done. Third one is the NDP. That is also done. Now the fourth one is NNP. Net National Product. Net National Product. What is this NNP? Now listen to me carefully. GDP measures the market price of all the final goods and services produced within the territory of India. GNP measures the market price of all the final goods and services which are produced by residents of India. NDP measures the market price of all the final goods and services which are calculated, or market price is calculated after accounting for depreciation. Now, what is this NNP? NNP simply represents the market price of all the final goods and services. I repeat, the market price of all the final goods and services which is done by the residents of India. Which is done by residents of India after accounting for depreciation. Meaning what? Let's imagine, right, companies in India. These will produce in India as well as outside India. Because these are Indian companies. I repeat, these are Indian companies. In the process of producing the goods and services, they will be consuming capital. They'll be using capital. And this particular capital, right, just an example, machinery, because they are using it to produce goods and services, will be undergoing wear and tear. The value of this machinery will keep on decreasing. So earlier, when you calculated GNP, when you calculated the gross national product, you did not account for, I repeat, you did not account for the consumption of capital. You did not adjust for the consumption of fixed capital or consumption of machinery, that is depreciation. Now we need to adjust that as well, so that you can simply generate, you can simply get a number which represents the incomes earned by the residents of India, whether within India or outside India. So what do? We already have GNP. Right? From GDP, we have calculated GNP. From GNP, now simply take out depreciation. From the GNP, now simply take out the depreciation. Right? So when from the GNP you subtract the depreciation or take out the depreciation, what you're essentially going to get is the net national product. Net national product, NNP. Everybody is okay with this? Please do let me know. Everybody is okay? Right? So these are the various indicators. These are the various indicators that are essentially used, right? Essentially used to calculate, right, how productive the economy is, right? To what extent the policies of the government, right, whether within India or outside India, to what extent the policies of the government are promoting production of final goods and services. I'll repeat all the four again, right? I'll just summarize what we have discussed in the last 50 plus minutes. One is the GDP, gross domestic product, market price of all the final goods and services which are produced within the territory of India. This is a geographic concept. Then there is a GNP. GNP is a nationality concept. Here, the focus is on the market price of all the final goods and services which are produced by the residents of India, whether within India or outside India. That is GNP. Then there is a NDP, net domestic product. What is the importance of NDP? It represents the market price of all the final goods and services which are produced after adjusting for depreciation. And what is depreciation? The depreciation represents a reduction in the value of a particular asset because there is a wear and tear in the machinery or in the asset. Right? That is depreciation. And then finally there is a NNP, net national product. Right? The net national product represents the market price of all the final goods and services which are produced by the residents of India, whether within India or outside India, and after adjusting for depreciation. After adjusting for depreciation. Done? Right? So these are the various indicators that are generally used. These concepts are relevant for the UPSC Prelims examination, Mains examination, as well as the other competitive examination as well. So that's it from my side in today's session. If you have liked this particular session, do not forget to hit the like button. If you are yet to join our YouTube channel, kindly do it right now. Thank you. Have a great day.